than Rahul Bhasin from Bearing Private Equity Partners India to really talk about what's going on in the primary market and whether or not one should be trapped in the frenzy that seems to be at play. Rahul, so good having you today on the show. Thank you so much for taking the time out. Rahul, first things first. I mean, do you think the class of 2024 IPOs is different from the class of 2021, wherein there was the frenzy, there were the fancied names, but there was also no path to profitability? Do you think first things first, we need to make that disconnect?
Look, I'll break that up into two parts. I mean, one part is the fact that, you know, mostly IPO markets give very good returns for investors when there's been a drought of IPOs for an extended period of time. Right? So when you're talking about 21, there'd probably been a lull in the IPO market for almost a decade before that. And virtually IPOs had dried up. And then when you start seeing IPOs, usually it's in the first year after a drought that you usually get higher quality companies. Um, yes, there was an issue, an adjacency issue also, and I'll come to that second. But the general trend is that you will end up usually getting better returns as an investor in IPOs very early in the cycle of IPOs coming back into the market, coming back into fashion. As that cycle matures, the returns tend to get lower and lower. Also, if you actually map the returns, generally IPOs are when very knowledgeable insiders are paying extremely knowledgeable investment bankers who are earning fees which goes from anywhere between 4 and 9% of the issue price, depending on the size of the IPO, to go and market their company. That usually is at a time of the optimum time from the perspective of the company and the seller, very rarely from the buyer's perspective. So usually the odds are kind of stacked against you as a buyer when you're participating in an IPO. Doesn't matter which IPO, doesn't matter where in the world. The reason why most people and most professional investors will look at IPOs very carefully is because usually disclosure levels and information about the company tends to be the maximum, and you can find gems once in a while in an IPO. But for the common layperson, it's a very hard game to play successfully and meaningfully. There will be every now and then in the tech ecosystem or the changing or evolving ecosystem or the new sectors where you'll get fantastic IPOs. I mean, if people simply missed IPOs, they would have missed in the last 20 odd years Amazon, Google, Facebook. So nationally, and a lot of these disruptive kind of companies, even in India. So there is that ecosystem where you cannot use these rules that you should use for the conventional part of the market. And again, if you track and break down returns, you'll see that the returns, whether it's in 21 or Zomato night might right now be looking an exception. But if you look at 21, 22, 23, if you look at the returns, they really haven't as a class outperformed the markets. In fact, I would suggest that they've underperformed markets meaningfully, even if the companies are giving you a return.
Right, Rahul, morning. Let's also understand what your outlook is then when it comes to some of these companies actually staying afloat. How would you have looked or mapped out certain journeys where you believe valuations have been unjustified, that the profitability metric needs to be monitored more closely, and now that is going to be something that companies that will list will take cognizance of?
I think that in technology cycles, I'm a big believer that there is going to be a shift from the internal combustion engine to the EV ecosystem. But when you are making calls and bets on that, you're making calls on so many variables, including what's going to be the subsidy regime going ahead, what's the relative competitive advantage of A company has versus B company, how is the market structure going to evolve, what about the distribution? These are new products in a new market. What is the service support or the predictability? What about overcoming brand And can the incumbent play the same game? Is there that much entry barrier on the production side? Are there economies of scale? I'm saying there's so many questions that the people have to answer. And if you just jump into saying that this is a big trend, and therefore any company which is in this big macro trend and jump after it, I think that you can be assured of a bumpy ride. The other sort of small data point I'd like to point out is that there were 18,000 automobile companies at the end of World War I in the US, and in 1954 there were 4. So sometimes it makes sense to actually wait and see who survives and who wins that battle. And I'm making these comments more specifically to the retail set, who's probably a little bit suffering from FOMO and jumps into a lot of these names upfront. But will these companies change the world and the way you and I live and probably come to work and travel? Absolutely, they will.
Right. The other thing, Rahul, that I wanted to talk about is the point that you were making earlier as to how this is a market cycle. For the last 10 years, IPO just didn't do anything, and 2021 you had a barrage, and we continue to do so. Where do you think we are in that cycle? Because in just the last 2 months alone, we've seen almost 20 of them, and all of them doing well. All of them are cases, or rather large part of them are cases where one can debate about whether or not you want to pay that kind of a price for a particular company and the growth visibility they have. And some of the marquee investors have been checking in across the board. I mean, some of the large cap names and some of the smaller ones as well.
I think that you have to put it in the broader perspective of where the market is. The market right now, we are, again, in terms of economic cycles, we are definitely on an upswing. Real estate is on an upswing. Manufacturing is on an upswing. We've seen downs on the IT and the services side. There's a likely upswing there. So from a cyclical perspective, we are definitely on an upswing. And from a structural perspective, we are crossing $3,000 per capita income. So you're likely to see an upswing even in terms of economic life cycle journeys of countries that structurally we're likely to move to a higher growth rate. But we are also, in terms of market cap to GDP, we are close to, I think, almost 160% market cap to GDP, where virtually any time in history one has seen that there are always severe corrections around these kinds of areas. Now, I don't expect that there will be such a serious sell-off because, number one, if one were to look at the liquidity position, I think the mutual funds and different investors have maybe 1.5 crore of uninvested capital. So any sell-off is likely to be therefore shallow. But you will also have this situation where you have to assume that the growth that is necessary for you to pay for these valuations, a lot of that is already built into the price. So it's very hard to conceive how at a market level or an aggregate level, you can get such high returns. Now, these IPOs are being priced off the current market levels, right? So you might see some amount left on the table to induce you to come in there. But overall, at an aggregate level, the markets are expensive and probably due for a correction. Whether it's a time correction or a price correction is a different thing. But there will be some combination of this. And I think at an aggregate level, returns will definitely be lower. And you're, like I said, you're buying from a very intelligent seller.
Yes, intelligent sellers, but are they equally intelligent buyers? That's the question. Thanks so much, Rahul, for making time and speaking with us today. Appreciate you joining us on the show.
My pleasure. Thank you.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.